Tired of dropping your phone or struggling to prop it up? Meet the PopSockets phone grip with expanding kickstand in black, your new must-have accessory. Don't miss out. Grab yours today. Click the link in the video description to shop now on Amazon.
Hey everyone, welcome to Bitcoin Bulletin. Today we're talking about XRP versus Bitcoin during Trump's tariff war. So, when President Trump slapped a blanket 10% levy on all imports in April, gold prices shot up as investors flocked to safe assets. But what happened with cryptocurrencies? Bitcoin took a hit after the US imposed tariffs on European goods, shedding around 2.5% initially. Meanwhile, XRP was quietly trading above $2.20. Now, let's look at the narrative here. Gold is doing well because when policy risk jumps, capital chases scarcity. And Bitcoin sells that same story as part of its investment thesis. Only 512 new coins are mined daily, and the crypto's price is up by 11% this year so far. However, tariffs sap global liquidity via higher input costs and slower trade, which tilts short-term flows toward cash, not volatile assets. That means Bitcoin's perceived safety status remains largely unproven and conditional on risk appetite. Assuming the White House follows through with more sector-specific tariffs, as President Trump keeps claiming, Bitcoin could experience doldrums until the ongoing uncertainty passes. But over the longer haul, its margin of safety is driven by supply, not headlines. If broad tariffs weaken the dollar, a non-fiat currency store of value with deep liquidity may absorb the same inflation hedge inflows that gold currently enjoys. That edge would be structural and long-lasting if it happens. Bitcoin may win the narrative war over the long haul, but XRP is quietly winning contracts that increase its value today. Ripple recently announced expanding the XRP network to include Zanbank and a fintech called Mamo, both based in the UAE. Tariffs reroute supply chains, creating new bilateral corridors across which money needs to flow smoothly. It's easier for that to happen with solutions that natively comply with local regulations. XRP's relatively new features like account freeze, blacklist, and trustline let banks satisfy know your customer and anti-money laundering rules without requiring patchwork fixes that other blockchains might. If tariff policy turbulence endures, XRP's cross-border payment volume should grow even if the overall trade shrinks, because companies can fragment production to dodge duties. And there's always an incentive to cut costs. XRP's niche of cheaply settling money transfers across borders could see persistent throughput gains. Yet investors must recall that these flows translate into modest net buying of XRP for liquidity, not necessarily long-term locking, as with Bitcoin purchased for holding. So, which asset fares better depends on your investing timetable and risk tolerance. Bitcoin's upside rests on scarcity, which isn't going anywhere regardless of tariffs or the lack thereof. It's the more conservative choice. For long-term oriented investors looking for a digital alternative to gold, Bitcoin might be preferred due to its proven scarcity and growing status as an investment that institutions want to hold. However, XRP offers a different risk curve. XRP is the riskier and more volatile investment, but it likely has a better chance of growing faster over the next year or perhaps even longer due to its actual utility. Its utility as a payment processor and money transfer platform means that demand for the coin rises when trade friction rises, but it isn't scarce at all. More supply is unlocked from escrow each month. Meanwhile, any setback in Ripple's regulatory diplomacy could freeze adoption overnight. No outcome is guaranteed here. It might be a good move to buy both coins, provided you're willing to hold them. That's the story of XRP versus Bitcoin during Trump's tariff war from Bitcoin Bulletin.